My experience is that most tax preparing CPAs and EAs look backwards at the previous year's tax experience. It takes overt client requests to have them do any forward planning. As such, the more advanced financial advisor with a good understanding of the U.S. tax code and the respective state's tax code might be a better source of advice. Here are a few things to consider during the different decades of your life. In your 40s, one key strategy is to buy real estate, a home, a townhouse, whatever. If part of your compensation package is company stock, you can use your concentrated stock position as a collateral for a rather huge down payment. Many lenders, in lieu of cash down payment, will allow you to pledge liquidatable assets on that mortgage purchase. A very seasoned mortgage lender that I know with multiple homes confided in me that had she had it to do over again, she would have bought her rentals first. This would get her into the real estate market while having renters pay the mortgage service. As you know, there are many tax advantages to real estate, especially rentals. Another approach is to buy, invest in, and place private equity. This will give you excellent returns, but it's illiquid. Private equity demands attending to cash calls, and the holding periods might extend to years beyond projects. But again, the returns might justify that long holding period. Here's the tax twist, though. Private equity reports taxes annually on a K-1. Depreciation and other tax advantages flow to you, the investor. In your 50s, continue to buy rental real estate with that income you're not spending. Continue buying private equity with that income you're not spending. Also, if you have the desire and time, start a one-off business, put it in an entity like a subchapter S corporation or an LLC. In today's world, if you are in fact earning more than you spend, you will undoubtedly be using a company retirement plan. Even retiring in your mid-60s, there is a great temptation to delay taking money out of the tax-deferred plan until you are required to by required minimum distributions. Now, there's a drawback to this. In many cases, that account grows to over $2 million, which then demands your required distributions in your early 70s of over $80,000. That's a lot of taxable income. How do you reduce this burden? One way is by changing your contributions to a Roth 401k or IRA. Now, some will counsel against this because you're not getting the IRA tax benefit. I understand this is a legitimate objection when you're looking at the current tax year. But if you're looking at it over the arc of your life, maybe not so much. Having higher taxable income in your 70s will require you to deal more sensitively to Medicare Part B and Part D costs, as well as potentially higher tax rates. So this must be part of the discussion in your 50s. While this next suggestion contradicts the previous one, every taxpayer is different. Defined contribution plans are great, but defined benefit plans or cash balance plans allow you as the employer to defer far more money in excess of 401ks. While every situation is different, this ought to be part of the conversation.